Hello everyone, welcome back to my YouTube channel. In this video, it's my pleasure to share this topic entitled Risk, Return, and the Capital Asset Pricing Model, or the CAPM. For reference, please refer to the description. Okay, in this chapter, we start from the basic premise that investors like returns and dislike risk. So, therefore, people will invest in riskier asset only if they expect to receive higher returns. So, we define precisely what the term risk means as it relates to investments. In later chapters, we extend this relationship to show how risk and return interact to determine security prices. Okay, the following key points are: first, understanding risk and return in investment. The next one is calculating the expected return using the capital asset pricing model. Then the last one, interpreting the relationship between risk, return, and the CAPM formula. So, in this chapter, we will be focusing on the following content, namely: first, investment return; second, standalone risk; third, risk in a portfolio context; four, calculating beta coefficients; then the relationship between risk and rates of return. Then the last one, the CAPM, risk and return, is something missing. Next slide. Okay, now let's understand and explore the concept of risk, return, and the capital asset pricing model. Let's define the following terms. First is risk refers to the uncertainty of return. Understanding and managing it is crucial in investing. So there is the possibility that the actual return on an investment may differ from the expected return. The second one is return, is the gain or loss on an investment over a specified time period, is the reward for taking risks. So in investing, there is typically a trade-off between risk and return, meaning that higher potential returns are usually associated with higher levels of risk. Okay, what is risk return trade off? Risk return trade off is an investment principle that indicates the higher the risk, the higher the potential reward. The third one is capital asset pricing model. Is a widely used method to determine expected returns on investment. So the statement CAPM measures the expected return on an investment based on its risk, means that according to CAPM, the expected return of an investment is determined by its level of risk. In simpler, in simpler terms, the more risky an investment is perceived to be, the higher the expected return should be according to CAPM. This reflects the idea that investors should be compensated for taking an additional risk. Okay, next slide. There's a question here. Why investors often seek higher returns for riskier investment? So investors often seek higher returns for riskier investment due to the concept of risk return trade off. So these principles suggest that higher returns are expected to compensate investors for taking on higher levels of risk. Okay, let's proceed to the uh, next slide. Okay, investment returns. So this is one of the key concepts. So what is investment return? It is a way to evaluate how well an investment has performed financially. It refers to the profit or loss generated from investment over a certain period. So, with most investments, an individual or business spends money today with the expectation of earning even more money in the future. So, the concept of return provides investors with convenient way to express the financial performance of an investment. So that the return on an investment can be expressed in both dollar terms and percentage terms to provide a clearer picture of its performance. So let's define dollar return and rate of return. Okay, dollar returns provide a straightforward measure of the actual monetary gain or loss from an investment. Here in the Philippines, it's peso return. So how about rate of returns? Offer a standardized percentage-based measure that accounts for the size of the investment and the timing of cash flows, making them more suitable for comparing investment of varying magnitudes and duration. So let's cite an example. First example is, suppose you buy 10 shares of a stock for $1,000. So the stock pays no dividend, but at the end of 1 year, you sell the stock for $1,100. What is the return on your 1,000 investment? So one way to express an investment return is in dollar terms. So dollar return equals amount to be received minus amount invested equals what is that is the dollar return. So let's solve this example. So dollar return equals the amount you receive. What is the amount you receive? $1,100 minus amount invested. Okay, you invested so $1,000. So 1,100 minus 1,000 minus equals $100. So therefore, the dollar return is $100. Note, if at the end of the year you sell the stock for only $900, so your dollar return will be negative $100. How do you solve that one? Okay, a dollar return minus the amount you receive, which is $900 minus 1,000, the amount you invested. So therefore, your is your dollar return is negative 100. So although expressing returns in dollar is easy, two problems arises. So first, to make a meaningful judgment about the return, you need to know the scale or the size of the investment. So a $100 return on a 100 investment is a great return, assuming the investment is held for 1 year. But $100 return on a $10,000 investment would be a poor return. Okay, that is one of the a problem. So second one, you also need to know the timing of the return. A $100 return on a $100 investment is a great return if it occurs after 1 year. But the same dollar return after 20 years is not very good. So the solution to this scale and timing problems is to express investment result a rates of return or percentage return. Okay, next slide. So, example, the rate of return on 1 year stock investment when 1,100 is received after 1 year is 10%. How we solve that one? The rate of return equals AR or the amount received minus AR okay divide divide AI. Okay, rate of return equals 1,100 minus 1,000. Rate of return equals $100 over one no divided 1,000. Rate of return equals 0.10 or the 10%. Okay, in this scenario, your stock investment has generated 10% return. So it's just like a gardening analogy. Investing is like planting seeds in a garden. The amount of return you get is akin to the number of fruits you harvest after growing the seeds, just as a good harvest signifies a successful gardening season. So a high return on investment indicates a successful financial move. So why are rates of return superior to dollar returns in terms of accounting for the size of investment and the time of cash flow? So rates of return offer a more comprehensive and standardized way to evaluate investment performance. So, accounting for both the size of investment and the timing of cash flows, which makes them superior to dollar returns in many contexts. So, therefore, as an investor, we need to know deeply what is investment risk. Okay, it says here that investment risk, it refers to the potential for loss or uncertainty associated with investment return. It encompasses various factors such as market volatility, economic conditions, company performance, and regulatory changes. So investors typically seek to balance risk and return according to their risk tolerance and investment objective. As we all know, that risk refers to the chance that some unfavorable event will occur. Investment risk, as I have said a while ago, it refers to the potential for loss or uncertainty associated with an investment return. Example, if you go skydiving, you are taking a chance with your life. As we all know that skydiving is risky. If you invest in speculative stock or any stock, then you are taking a risk in the hope of earning an appreciable return. Okay, an asset risk can be analyzed in two ways. What are these? Standalone risk, risk in portfolio context. So, thus, an asset's standalone risk is the risk an investor would face if she held only this one asset. Obviously, most assets are held in portfolios, but it is necessary to understand standalone risk in order to understand risk in a portfolio context. So, let's cite an example. Example, suppose an investor buys $100,000 of short term treasury bills with an expected return of 5%. So, in this case, the rate of return on the investment 5% can be estimated quite precisely, and the investment is defined as being essentially risk free. However, if the $100,000 were invested in the stock of a company just being organized to prospect for oil in the mid-Atlantic, then the investment return could not be estimated precisely. One might analyze the situation and conclude that the expected rate of return in a statistical sense is 20%, but the investor should recognize that the actual rate of return could range from, say, plus 1000% to negative 100%, because there is a significant danger of actually earning much less than the expected return. So this stock would be relatively risky. Risky. In our example, it is clear that few, if any investor, would be willing to buy the oil company stock if the expected return were 5%, so the same as that of the treasury bill or the T-bill. In essence, standalone risk helps investors understand the potential uncertainty and variability of returns associated with individuals' assets, so providing insight into the level of risk they are exposed to when investing. So in every investment, there is always a risk. Therefore, there is what we call probability distribution. What is probability distribution? If all possible events or outcomes are listed, and if a probability is assigned to each event, the listing is called a probability distribution. For example, a weather forecast might state there is 40% chance of rain today and a 60% chance that it will not rain. So keep in mind that the probabilities must sum to 1.0 or 100%. Okay, probability distribution for sale.com and basic food. Sale.com is an internet company that offers deep discounts on factory, seconds, and overstock merchandise. Because it faces intense competition, its new services may or may not be competitive in the marketplace. So, its future earnings cannot be predicted very well. Indeed, some new company could develop better services and literally bankrupt sale.com. So Basic Foods, on the other hand, distributes essential food staples to grocery stores, and its sales and profits are relatively relatively stable and predictable. So the rate of return probability distribution for the two companies are shown in figure 6-1. So there is a 30% chance of strong demand, in which case both companies will have high earnings, pay high dividends, and enjoy capital gains. So there is 40% probability of normal demand and moderate returns, and a 30% probability of a weak demand, which will mean low earnings and dividends as well as capital losses. Notice, however, that sale.com's rate of return could vary far more widely than that of basic food. There is a fairly high probability that the value of sale.com's stock will drop substantially, resulting in a 70% loss, while there is a much smaller possible loss for basic foods. Note that the following discussion of risk applies to all random variables, not just stock return. Okay, expected rate of return. If you multiply its possible outcome by its probability of occurrence and then sum this product as in shown in table 6-2, we have a weighted average of outcomes. So the weights are the probabilities and the weighted average is the expected rate of return. R hot or the cold R asterisk hot. I think it's not asterisk, but it is R hot. The expected rates of return for both sale.com and basic foods are shown in table 6-2 to be 15%. So this type of table is known as payoff matrix. Okay, now the expected rate of return calculation can also be expressed as an equation that does the same thing as the payoff matrix. Table 6-2. Sale.com, this is the solution. Okay, rate equals 0.3 times 1 plus 0.4 times 0.15 plus 0.3 times -7. So therefore, the expected rate of return is equal to 0.15 or 15%. So that is for the sale.com. How about the basic foods? Rate of return equals 0.3 times zero point 0.4 plus 0.4 times 0.15 plus 0.3 times negative zero point 0.10. So therefore, the rate of return for the basic food is 0.15 or 15%. Okay, from this figure, which of the stock graph in figure 6-2 is less risky and why? So the concept of graphing rates of return to visualize the variability of the possible outcomes for investment. So in this scenario, bar charts are used to represent the probabilities of different outcomes, with each bar's height indicating the probability of that outcome occurring. So it discusses two hypothetical investment, sale.com and basic foods. Both have an expected return of 15%, but their ranges of probable returns differ, right? So, sale.com has a wider range from 70% to 100%, while ang basic foods has a narrower range from 10% to 40%. So this means that sale.com has a higher degree of variability in its potential returns compared to basic food. It also shows the idea of assigning probabilities to various levels of demand and corresponding rates of return for its investment. So the graph illustrates that the shape of the probability distribution curve can indicate the level of risk associated with an investment. A tighter or more peak probability distribution suggests that the actual outcome is more likely to be close to expected value. Consequently, investment with tighter probability distributions are considered less risky because there is less chance of the actual return deviating significantly from the expected return. So since basic foods has a relatively tight probability distribution compared to sale.com, its actual return is more likely to be closer to its expected return. So therefore, basic foods is considered less risky in this context. So how does one calculate standard deviation? To be most useful, any measure of risk should have a definite value. We need a measure of the tightness of the probability distribution. One such measure is the standard deviation, the symbol for which is pronounced sigma. So the smaller the standard deviation, the tighter the probability distribution, and accordingly, the less risky the stock So to calculate the standard deviation, we proceed as shown in table 6-3, need to the following steps rather. Okay, this is the first these are the steps, and the next one is the number finding the finally find the square root of the variance to obtain the standard deviation. So this is the formula on how to get the standard deviation. Okay, thus the standard deviation is essentially a weighted average of a deviation from the expected value, and it provides an idea of how far or below the expected value the actual value is likely to be. In sale.com, standard deviation is seen in table 6-3 to be how much? 65.84%. So using the same procedure, we find basic food standard deviation to be 19.36%. So sale.com has the larger standard deviation, which indicates a greater variation of returns, and thus a greater chance that the actual return may be the substantially lower than the expected return. Okay, so using this using the same procedure, we find basic food standard deviation to be 19.36, as I mentioned earlier. So, therefore, sale.com is a riskier investment than basic food. Okay, there's a question here. Most investors are risk averse. Why? What does it mean? So it means that the majority of the investor prefer investment with lower level of risk over those with higher levels of risk given the same expected return. So this preference arises from the natural tendency of individuals to prioritize the preservation of their wealth and financial security. Overall, while there are certainly exemptions, the statement most investors are risk averse so reflects a common trend in investment behavior driven by a preference for security and a desire to avoid potential losses. Okay, in the preceding section, we considered the risk of asset held in isolation. Now, we analyze the risk of return held in portfolios. As we shall see, an asset held as part of the portfolio is less risky than the same asset held in isolation. So accordingly, most financial assets are actually held as part of portfolios. Example, banks, pension funds, insurance companies, mutual funds, and other financial institutions are required by law to hold diversified portfolios. So even individual investors are at least those whose security holdings constitute a significant part of their total wealth generally hold portfolios, not the stock of only one firm. So this being the case from an investor standpoint, the fact that a particular stock goes up or down is not very important. Now, portfolio returns refer to the overall return earned on a collection of investment known as portfolio. So it represents the aggregate performance of all the assets held within the portfolio weighted by their respective contribution to the portfolio's value. As we just saw, the expected return on a portfolio is simply the weighted average of the expected returns on the individual asset in the portfolio. However, unlike returns, the risk of a portfolio P is generally not the weighted average of the standard deviations of the individual assets in the portfolio. The portfolio's risk will almost always be smaller than the weighted average of the assets. In fact, it is theoretically possible to combine stocks that are individually quite risky as measured by their standard deviation to form a portfolio that is completely reckless. Okay, to illustrate the effect of combining assets, consider the situation in figure 6-4. The bottom section gives data on rates of return for stock W and M individually, as well as for the portfolio invested 50% in its stock. So the three graphs plot the data in a time series format. The two stock would be quite risky if they were held in isolation, but when they are combined to form portfolio WM, they are not risky at all. Note, these stocks are called W and M because the graphs of the returns in 6-4 resemble a W and an M. So the reason stocks W and M can be combined to form a reckless portfolio is that their returns move counter-cyclically to each other. So when W's return fall, those of M rise and vice versa. So the tendency of two variables to move together is called correlation. And the correlation coefficient measures this tendency. So the symbol of the correlation coefficient is the Greek letter RHO, or pronounced rho. In statistical terms, they say that the returns of stock W and M are perfectly negatively correlated with 1.0. So the opposite of perfect negative correlation with 1.0 is perfect positive 1.0. Returns onto perfectly positively correlated stock W and M would move up and down together, and a portfolio consisting of such stocks would be exactly as risky as each individual stock. Okay, this point is illustrated in figure 6-5, where we see that the portfolio standard deviation is equal to that of the individual stock. Thus, the diversification does nothing to reduce risk if the portfolio consists of perfectly positively correlated stock. Figure 6-4 and 6-5 demonstrate that when stocks are perfectly negatively correlated, all risk can be diversified away. But when stocks are perfectly positively correlated, 1.0 diversification does no good whatsoever. So in reality, virtually all stocks are positively correlated, but not perfectly so. So past studies have estimated that the correlation coefficient for the monthly returns on two randomly selected stock is about 0.3.9. Under this condition, combining stock into portfolios reduces risk but not completely eliminate it. In figure 6-6 illustrate this point with two stocks whose correlation coefficient is point, uh, 0.35. So the portfolio's average return is 15%, which is exactly the same as the average return for our other two illustrative portfolios, but its standard deviation is 18.6%, which is between the other two portfolios' standard deviation. So understanding the correlation between assets is important for portfolio diversification. Assets with low or negative correlation can help spread risk within a portfolio, as they are less likely to move in tandem during market fluctuation. So conversely, assets with high positive correlation may not provide as much diversification benefit as the return tend to move. Okay, calculating beta coefficient. So in particular, the beta coefficient used by investors should reflect the expected volatility of a given stock's return versus the return on the market during some future period. However, people generally calculate betas using data from some past period and then assume that the stock's relative volatility will be the same in the future as it was in the past. So table 6-4 shows the betas for some well-known companies as provided by two different financial organizations, Sachs and Yahoo. Finance noticed that their estimates of beta beta usually differ because they calculate beta in slightly different ways. So given these differences, many analysts choose to calculate their own beta. Okay, the second step is to convert the stock prices into rates of return. For example, to find the May 2006 return for GA, we find the percentage change from the previous month, $34.59, 34.33 divide 34.59 dollar. So 0.008 equals negative 0.83. So we also find the percent change of the S&P index level and use this as the market return. As table 6-5 shows, GE had an average annual return of 6.9% during this 4-year period, while the market had an average annual return of 5.4%. As we noted before, it is usually unreasonable to think that the future expected return for a stock will equal its average historical return over a relatively short period, such as 4 years. So, however, we might well expect past volatility to be a reasonable estimate of future volatility, at least during the next couple of years. So note that the standard deviation for GS return during this period was 19.1% versus 13.0% for the market. Okay, for the market. So that's the market volatility is less than that of GA. This is what we would expect. Since the market is a well diversified portfolio and thus much of its risk has been diversified away, the correlation between GS stock return and the market return is about 0.49%, which is a little higher than the correlation for a typical stock. Okay, the relationship between the risk and the rates of return. So the relationship between the risk and returns, rates of return. In the preceding section, we saw that under the CAPM theory, beta is the appropriate measure of a stock relevant risk. Now we must specify the relationship between risk and return. For a given level of risk as measured by beta, what rate of return should investor require to compensate them for bringing that risk? To begin, let us define the following terms. Okay, this one. Ehrhardt, expected rate of return on the ICE stock. RI, required rate of return on the ICE stock. This is the minimum expected rate of return required to induce an average investor to purchase the stock. So these are the terms that we need to know, and so that we will understand the relationship between the risk and risk rates of return. Okay, let's try to solve this one. Problem solving. There are three situation or problem solving that we need to solve. First is an individual has $35,000 invested in a stock which has a beta of zero point 0.8 and $40,000 invested in a stock which is a beta of 1.4. If these are the only two investment in her portfolio, what is her portfolio's beta? The second one, assume that the risk-free rate is 6% and expected return on the market is 13%. What is the required rate of return on a stock that has beta of 0.7%? The last one is assume that the risk-free rate is 5% and the market risk premium is 6%. What is the expected return for the overall stock market? What is the required rate of return in a stock that has a beta of 1.2? Okay, I if you want to answer, you can leave comment, send your answer. Just utilize the comment section so that I can help you with this problem that's given, that is given, right? Okay, so just comment in the comment section, and please don't forget to click like and subscribe for my YouTube channel Filonsky Forever. So now it's time for you to check if your Answer is correct. I have given the solution here, but you need to solve uh, in your own solution, so that you will be familiar in this scenario, especially in you just use the formula that I have shown you earlier, so that you can solve this problem. Okay, so I think this will be the last slide, or the second to the last slide. Okay, so are you done answering? So okay, just leave your comment there. Okay, the last slide for the conclusion. So this chapter discusses the trade-off between risk and return in investment. So it covers various topics, including calculating risk and return of individual assets and portfolios, the benefits of diversification, and the capital asset pricing model, or the CAPM, which explains how risk influence rates of return. So the key concept include the risk defined as the chance of unfavorable events, distinguishing between standalone risk and risk in portfolio context, and investor preference for portfolio risk over individual asset risk. Another one is expected return as the means value of the return probability distribution. And next is higher standalone risk necessitates higher required returns. So diversifiable risk and market risk components of an asset risk. Diversification in risk, return, and CAPM involves spreading investment across a variety of assets to reduce unsystematic risk, optimize the risk return trade off, and align with the principles of the CAPM framework. So, by diversifying their portfolios effectively, investors can potentially enhance their risk adjusted returns and mitigate the impact of adverse market events. So, calculation and interpretation of beta coefficient as a measure of market risk. Another one, security market line, or the SML equation relating market risk to required return. So factors influencing changes in required rate of return and benefits of global diversification for multinational companies and portfolios. So overall, the chapter provides fundamental knowledge for estimating required rates of return. And I think that's all for uh, my topic, the risk, return, and the CAPM. I hope you learn something new. Goodbye, everyone.